Good morning, everybody. Welcome to the Flow Show, the day after the night before, or the morning after the morning before. I don't know what it is. Kay, do you know what it is?
I've lost count, mate. I mean, it's 10:30 in the morning. That's the only thing we know.
Yeah,
and we have to kick off. There's quite a bit to talk about today. Eh?
Yeah, we do. So we'll get straight into it. We'll look at a bit of data first out of Japan, just quickly. Some machinery orders, core machinery orders, showing a bit of an improvement coming into March, up 2.9% month on month, turning around an expected minus 1.8 expected. So good numbers there. Year on year numbers also looking healthy, going positive 2.7% from a negative 1.8% previously. The manufacturing sector area hasn't been overly hot in Japan of late, so that'll be some good news. Our FX man Kanda has been speaking at this G7 finance ministers thingy, or head of it. He said that Japan needs to take action to make its economy more internationally competitive. And he urges the country to tackle structural reform and take that on to get the economy working a bit better abroad. So speaking ahead of this G7 shindig in Italy, which starts today, I think, with some Eurogroup meetings and whatnot. And then we get the finance ministers and central bankers and all that mob piping up at some point in the latter part of the week. Over to Kiwi land, and a bit of a surprise from the RBNZ. They left their cash rate unchanged as expected at 5.5%, but they did hike up their forecast for the cash rate over the next few quarters, Q3, Q4, Q1 next year, Q2, Q3, all the way through. There was a bit of an uplift in where they expect rates to be. So the highest rate they're expecting is 5.65% in Q4. Probably the biggest shift, though, was in Q1 2025. They raised it to 5.62 from 5.47. So that's a whole 25 pip hike. At 5.47, just 3 pips below where the rate is currently. Now, it should be said that these forecasts don't necessarily indicate that they're going to hike rates or anything like that. It's at the moment, it's more reinforcing that they're going to stay higher for longer. But they did add a hawkish shift to the statement, saying that monetary policy may need to tighten and or remain restrictive for longer if wage and price setters do not align with weaker productivity growth rates. In their price statement, the only thing they had around whether they were going to keep rates on hold or change them was saying that ongoing restrictive monetary policy settings are necessary to reduce inflation. So they've added that they may need to tighten. Governor Orr added a bit of fuel to that fire, saying it will take time for domestic inflation to decline. The economy has a lower potential growth rate, and he's unsure if that is temporary. They have a limited upside room for inflation surprises, and that we had a real consideration on raising rates at this meeting. RBNZ Conway highlighting what I've just said, saying the OCR track is a central projection, not an absolute prediction. But I think the damage has been done, Kay. It's putting hikes back on the table, it seems.
Yeah. Especially even though they made a bit of a mention about the productivity risk, they have been taking away their jobs mandate, right? And so now they're only looking at prices, and those prices came in hotter than they were expecting. They were expecting the non-tradable inflation to come in around 5.3%. It came in around 5.8%, and yeah, as a result, they even discussed a hike, as you just mentioned. hardly. Well, we had this blip in the Kiwi as an immediate response, but we can hardly say it's absolutely smashing everything else out of the water. Right? It's relatively relaxed, this market. Although I think now that puts the Kiwi back as a real high yielder in let's say the G11 space, right? Where others are looking for cuts, or starting to look for cuts, like Lagarde told us yesterday again. Yeah, they are really the sticky ones, perhaps together with the Aussies as well, because the people may recall that they also discussed some possibility of a hike at the RBA. But yeah, it looks like the antipodians are going to stay higher for longer, and especially it's a pretty big adjustment that they made, as well in time as in expected rates. So yeah, I think that's going to keep. It should at least keep the Kiwi supported. But again, I think the market is not ignoring it, because the Kiwi is stronger against other currencies in the crosses, but we are still very data dependent, right? So the first set of negative data out of there, and or could do 180, as we have seen already in the past. So a bit cautious, but I do think that the Kiwi is going to remain supported, whether it's versus dollar at somewhere in that mid to high 60s, or I rather expressed it via smalls for now, but I'm looking to add a bit in the Euro Kiwi. Yeah, so yeah, it's really keeping them higher for much longer, it seems, because they really are pushed back, as I said, as well in time as in rates.
Yeah, do you think maybe that's a bit of a nod to the Fed and everyone else that's been moaning about the Fed staying higher? These guys, RBA and RBNZ, can keep a bit of hike language in there, even though it's probably unlikely they will hike. But they do keep their rates up near close to where the Fed is, so they're not going to get hit if the Fed stay higher. Do you think that's part of their thinking as well, rather than talking about FX and that sort of thing?
There's always a possibility of that, of course, but it seems to me that it's more like, even though their rates are a bit higher than those in Australia, it's more like looking at their cousins in Australia. That's the impression that I've got coming out of there, and showing their own independence as well. The others can do what they like. We are only handling our own stuff, right? Not to the Fed. I don't know. I mean, there is this possibility, but since there has been, well, I must say I haven't read the 60 pages of the statement, but was there anything about the currency in there? I'm not even sure. But
I
yeah,
don't think so. I had a quick look when I was doing the notes, and I didn't see anything.
keeping the yields towards the top end of the Fed funds range is maybe a tactic, right? Because we've heard other central banks talk about what could be the impact of the dollar versus their own currency if the Fed stays higher for longer versus them starting to cut. So there could be some sort of consideration, but I haven't seen anything mentioned in their statement.
Yeah, thanks, mate. And it should be noted that these are two of the banks that have been, well, maybe the most flip-floppiest all the way through this cycle of hiking, and then we'll see if they're the same when we look into cuts as well, because I think both went on pause and then had to hike again. So yeah, they're always a bit all over the shop, this lot. But anyway, little hawkish surprise from the RBNZ there. Over in the UK, yesterday during the flow show, we had the CPI industrial trends. Orders for May came out minus 33 versus 20 minus 20 expected. Let's see if that's on the calendar there. Where is it? 11 o'clock there. So minus 33. So this is industrials, manufacturing, that sort of thing. Another negative number. This is a bit like the Eurozone consumer confidence. It's very rarely in the positive. The selling prices component came in softer though at 15 versus 25 expected on a prior 27. So there was a bit of easing in price pressures there, which is news for the BOE. The IMF mentioned this yesterday that they hiked the UK growth forecast to 0.7% for 2024 from 0.5%. They did have some comments out after that. They said the BOE must articulate a clear rationale for future QT plans, and the BOE should cut rates by 50 to 75 basis points this year, and they expect them to cut a further 100 pips in 2025. The International Monetary Fools giving chapter and verse on what the UK should do. Their forecasts are as good as the rest of the financial industry, i.e. crap. So we won't take too much from that. And so we got this morning's news, the CPI that we've all been waiting for. And there we go, as expected, not as low as expected, 2.3%, close enough. You know, give a bit of credit. It was still a steep drop from 3.2%, but not quite at that 2.1%. The core, much stickier though, higher than expectations by 3 points, coming in at 3.9, down from 4.2. So that was more stickier, shall we say. Monthly numbers for the core as well, reflecting that too, up 0.9%. PPI, that was a little bit mixed, some down, some not as up as expected, and on and off, on and off. Overall, it still points to a bit of a sticky outcome there for inflation. So the market bought the quid on the fact that inflation didn't get down as much as expected, particularly on that core number. We've had the usual run around repricing, whether we're going to cut in June or August, and how many cuts we're going to get. We've no longer pricing in 2 full cuts this year. So the market now sees roughly 38 basis points of cuts this year. A June cut is now less than a 50% chance. August is up to around 44%. Barclays, one of the first out, saying they no longer see the Bank of England cutting rates in June. There we go with the old bank forecast again, not lasting longer than the ink dries on the paper. So what does it mean? Well,
better be early. Barclays better be early this time. Last time they were the last one of the lot to change anything, right? No, they said we can't be the last ones anymore. We have to go first now.
No, exactly. As I said in the chat room, if we get a really shocking retail sales on Friday, they'll probably be back to the June date anyway. But awful. So yeah, where are we in the overall picture for the Bank of England? Yes, we've had a strong move in the pound as those expectations get changed around. Okay, so context time, bigger picture time. That is a big fall. Okay, we're 3 pips off of target now. So that is good enough for the Bank of England. That core, though, I would say isn't. Unless that core is going to come down under, 3%, my rule of thumb pivot point for whether dovish or hawkish, then there's a chance that they're going to long it out and potentially June is off the table. Now, the Bank of England is one of these banks who will cut if inflation is on its way to target, not waiting until it gets to target, but that is pretty close to target. The next CPI report is a day before the June BOE, so that's going to be a real barnstormer. So we might need to strap ourselves down for that one. If it's a hot number going into June, then we're going to see some really fast change in expectations. But that's for then. At the moment, the BOE are a bank that want to cut. They desperately want to cut. The question is that headline number good enough for them to consider a cut in June, or will the core scare them off? I still favour August as the go date, though, as I've said, they are that desperate. It wouldn't be a surprise if they did go in June. But we really can't say anything now until we get that next CPI data. If that next CPI data has inflation below 2%, the core, even down to 3.5%, something like that, they will probably cut because they're so desperate to. Anything else? It's going to be a different story. So the quid has taken a bit of a rally. Cable, euro sterling dipping, cable rallying. But I think the market may have gone a bit too far in unpricing or repricing dovishness for the bank. What are your thoughts, Kay?
I think the market was already thinking that the expectations were low, and we have seen the sterling being quite resilient going into today's numbers. So you had a bit of an add-on, but I think also a good few people have seen this as an opportunity to take a few profits, and that's where we are now, I think. And we also know that inflation is not everything, but I think it's good enough to just keep the sterling bid on dips right now. But is it going to be good enough to break significant levels? And then I'm thinking about those high 120, anything from 127.5 up to 128 in the cable. Then the monstrous 85, the figure on the euro sterling. I think this is on everybody's radar now. That is now the question, whether we have enough power to do it. I'd say give it some time, and perhaps I always like to look at a few combinations, because tomorrow we have the PMIs, right? And if they paint the same picture, like quite positive, but the services PMI remaining quite high as well, I think that could be your kicker for then the sterling to take that next leg higher. I think for now, those who were long sterling have probably taken a little bit off and trying to manage it and waiting for those tomorrow PMIs. As you have been saying, as we've been saying yesterday as well, those expectations were like really very low, and but they are coming off, right? So we're still somewhere half. I'm still relatively positive towards sterling because it showed such a resilience. Also, we had and before you are going to ask me, we had these Bailey comments yesterday that they still want to continue to run off their balance sheet, but then will likely use more repo facilities to stabilize markets whenever needed for liquidity and so. So that's a little bit ball in the middle, 1-1, and then we kick again. But they continue to plan to run off the balance sheet at the Bank of England, and so that I'm not going to say would counterbalance any early cuts, because a cut is somewhere more important because it affects more people directly, right? But I think that combination should keep, I think, the sterling at least bid on dips for the time being. Is June completely off the table? We've been saying so often, right? Bailey is dying to cut. And perhaps these comments that he gave yesterday was a bit of a thing that's saying, like, even if we cut, and that's a little bit the same as Powell was saying at some time, even if we start to cut rates, we can still continue to run off the balance sheet, right? So that's a bit the combination there. Yeah, so I think all in all, sterling is going to remain a bit, and I really don't know about June, to be honest. I'm not 50-50. I'm less than 50% chance that they cut in June, but I wouldn't completely rule it out.
Yeah, no, I think I agree with that. And yeah, it's difficult with that headline number, 2.3%.
It's close.
But then they look at all the other bits and bobs. So we shall see. It's really tough to call. They probably want to cut in June. They'll probably be forced not to cut in June and push it to August or something, which has been my base case. But yeah, between a rock and a hard place as usual for Bailey, and most of the time it's of his own making. So he's been paid to do the job. So I'll leave it there. I'll leave it down to him, and I'll just react to the price moves as we get them. Right, well, we'll come back to look at prices in greater detail in a moment. Let's move on to some of the other bits and pieces. ECB's Nagel says rates should not be cut hastily, sees wages heading in the right direction. Says cutting rates too quickly would weaken what we have accomplished. ECB's Lagarde, she's probably put the final nail in the June hike for it happening, saying that she sees a strong likelihood of a cut in June if the price path holds, and is really confident that the ECB has inflation under control. I'm going to bookmark that comment for the months ahead. Sorry, Kay, was you adding something?
No, she talked about a cut, right? Yeah, I thought.
Yeah.
Maybe I misunderstood you. Don't worry.
No, I was saying putting a nail in the coffin, but that's not the right saying. She's putting the final nail in for a cut. Anyway, let's move on. Yesterday, Canada CPI data as well, and another bit of a surprise. So, headline number came in as expected, 2.7%. Nothing to write home about there. All their core numbers came in and around expectations. A medium, a pip softer, trimmed in line. The common was 2 pips lower than expected. The big news, however, was the BOC core number, which is that one right there, which came in at 1.6%. It was previously sitting at 2%. So outside of the SMB, this is one of the first majors to have a one handle on their CPI number. So that caught the market on the hop a little bit. So it was far more dovish data than it seemed at first glance. It took the Canadian dollar a bit of quite a few minutes to come around to the idea of that fact, and then we saw CAD pairs rising. So dollar CAD was shooting up on that one, pushing itself further away from that 136 area. The chances of a rate cut from the BOC rose to 48% for June from 40% before the data. So it tell you what how the expectations changed for that one. Bit of a surprise move in that one. It was almost like CAD should be selling on this, but it didn't.
That was one slow motion reaction, wasn't it? I mean, we were trading around what, 25-30 or so dollar CAD. There was all the time in the world to buy it just in the low 30s, and then before the thing went up to 70. So, but again, what I'm looking at, and yesterday on the face show as well, and what I was looking at is some of those Canada crosses, and we can hardly say that the market is completely on board with the lower Canadian dollar based on potential rate cuts coming, because I think even though is not as eager as a Bailey maybe or a Ramsden maybe in the BOE to cut, I still think that McClem is kind of hoping for such numbers to be able to start going quite dovish. Yeah. Rogers is a different thing. She's much more pragmatic about all these things. For her, I think they would be waiting for longer as well, and perhaps be at the Fed rate or I mean rate of change, not the interest rate, but the rate of change. But it's still, if you look at it, and especially I said on the crosser side, it's still a bit of a subdued reaction, right? Okay, we had those 40 points rally in the dollar CAD. Bit of the CAD crosses going up. One other interesting one I was watching was a sterling CAD. Haven't traded it, but we are breaking some levels there as well. But it's still not an overly big reaction, right? With such a 1.6 number coming in, and I really thought that we would be trading at slightly different levels already in the Canadian dollar right now. I'm not saying Canadian dollar getting completely destroyed, but like just small different levels, because it was relatively easy to come back to 136.40 on the dollar CAD, for instance. It is holding at the 30.40 zone, which should be holding before the bigger 136, 135.90. It is holding, but it's not really shooting either, especially today. We're seeing like the take sterling out of the equation. But we see the rest of the dollars picking up a little bit, but Canadian dollar is still hanging around there. And I don't know, isn't it enough for the market to sell the Canadian dollar? I mean, but possible, but I still think it's a low enough number to get the stiffers thinking about stuff, you know?
Yeah, I think these other numbers, yeah, it's going the right way. I think these numbers show it's going a bit slowly, a bit more slowly than expected. Although you could say it's a decent drop from the prior month. But yeah, it was a bit of a strange one. But then we know that it's another one. We know they're going to cut. It's just the when. And I think that's a different trade to if they were still going to hike or it was undecided whether they were going to cut. So yeah, it was a bit of a strange move. I mean, I know a load of us jumped in and those 30s. I was in it for about 2 minutes, and I thought, why is it not moving? It should be moving, and then eventually it woke up and started moving. But yeah, it hasn't got a huge amount. It's what it has probably done is just solidified all this support down here again. It was looking a bit of a coin toss while we were mooching around this area. 136, 30s, 50s, and down to 136. But with that move, we've seen support coming in 36, 15, 10, whatever you want to call it. So this is probably solidified now. So I'm less worried that we get a break. But if we do come down here pretty quickly, that might tell another story. But yeah, we'll see what Macklem has to say at his next appearance. I don't know when that is, but we'll keep our eyes peeled for that one.
Yeah, but by the way, I mean, even if all those central bankers may not be scheduled on the calendars, seeing that we have those G7 meetings, they can pop up at any time, right? Just for our audience to not to be surprised. Even if there's nothing on the calendars, they could still start to babble somewhere when they get asked questions by reporters or having a chat with the one or the other official that they will be meeting there. So just be aware that we can have like unexpected headlines from some of those guys.
Yeah, some doorstep comments, as we like to call them, or barside comments, as they'll be. We've sent our man Five Magics. He's in Italy, so we've sent him up there to do some reporting. Whether he makes it out the bar is another question altogether. Anyway, over to the US, and we had the Philly Fed non-manufacturing dropping as all the Canadian CPI came out. It's never on the calendar. That came in at minus 0.6 versus minus 12.4 previously. So the service side of the Philly Fed, not as crappy as it was last month. We had bigwig Fed's Waller speaking, saying he needs to see several more months of good inflation data before being comfortable to support an easing of monetary policy. But he said the exception to that would be a significant labour market weakening. He says further increases in the policy rate is probably unnecessary. The April inflation data suggests progress towards the 2% target has likely resumed, but that progress was modest. He said credit card and auto loan delinquency rates suggest some consumers are under stress. The progress back to 2% inflation may be a lot slower than seen last year, but he believes a Fed can rule out that inflation is re-accelerating. Says he just doesn't see rate hikes happening. He says holding rates for 3 to 4 months won't send the US economy off a cliff. Another load of comments I need to bookmark. Fed's Bar says we need to sit tight for longer than previously expected. Collins, it will take longer to see the progress needed to adjust rates. Mester thinks inflation will come down, but will take longer. Policy is probably not as restrictive as she would have thought. And there were a couple of other Fed heads, but nothing of note from them. Did you take anything away from Waller? He's always one that gets a lot of attention when he waffles.
Well, same higher for longer, and then time-stamping his cliff comments in case all of a sudden the data turns sour. But no, nothing really. They're all along the same lines. The one a little more sensitive to the minor changes or so, but I know I'm pretty much as expected. He has been walking both sides of the aisle for a while, and now he seems to side again more with the longer for longer rhetoric. So, but he seems to send us like to September or so. No, I it seems now that they are trying to get aligned for well, give and take 1 month difference for the first cut. But it looks as if let me just take my calendar with me. It looks that if we are, I think September is going to be the month where they should all move in line, I guess. That's what I'm thinking now.
Yeah, it's possible. I suppose it depends on that old data. I still think we need to start seeing a two-handle on inflation before they start talking about timelines. But yeah, we shall see. We got PC. Oh, we had that.
Yeah, on Friday, right?
Is it Friday? We've got it.
Let me see.
Or is it next
Oh
week?
no, on the 31st. No, on the 31st, I think next week. Yeah.
Next week, yeah. But we had that report out. Who was it? I can't recall who it was now. Slipped my mind. Timmy Leaks, wasn't it? Saying that the market is expecting PCE to go up at the next report. So that's next week. So that will be another one that's important. And if PCE jumps as well, that's going to be a lot of fun for the dollar and Mr. Powell and his unhikeable thoughts. But that's for next week. But yeah, we are, or some are expecting PCE to go up in the next report. So we'll see what one that brings. That's it on the news front. Unless you've got anything, Kay?
No, I think we covered everything right now.
Yeah, cool. So now I want your in detailed review of Bailey's speech from yesterday.
No, I've already said it. I mean, it's quite simple. Continue to run off the balance sheet, but if people need liquidity, they are going to go into the repo market, and they've got a bit of flexibility, yeah, in that repo thing.
Yeah.
It should be short-term, well, equivalent, let's say, to short-term loans. But to keep it simple, when they judge that there is not enough liquidity, or when people start to pull too much cash, they can inject it temporarily via that facility if they so wish. So that's his comment about bumps in the road and things, and increased repo usage from 2025. But no, it's in short, that's it. But I think the message is there that they just will continue to run up the balance sheet. The thing is, he did say that they won't go back to pre-pandemic levels, let alone pre-2008 or so levels. But they want to create room for if or when the next catastrophe will hit.
Yeah, thanks, mate. Right, Philip wants to have a look at oil. So let's bounce away from FX and have a little old butchers at oil markets to see what's going
70-80. 70-80.
70-80, yeah. Not much to write home about this one. We're back down to these lows, close to these lows that we had after coming off the high up near the 88s. So around this 50 fib is where we're holding. We can't seem to hold below it at the moment. But the bounces are pretty limited as well, up to that 38.2 fib, which is pretty much bang on the 80 buck mark. That's probably more the reason why we're finding resistance there. So I've got a little bit of a tight zone, 77s, maybe 76.5 to 70 to 80. That's your ballpark for now. So for direction wise, you pretty much want to go with whatever side breaks first. If you break through 76.5, then we're probably heading down to the 61.8 fib, and this is the rally that we've had since the latter part of December, mid-December last year. It's been a pretty strong rally, but if we get under here, that 61.8 is going to be a bit of a line in the sand, and then we're going to be heading lower. His Majesty over in America has said they're going to release, I think it was 1 million barrels of gasoline obviously to deal with prices over there as they go into driving season. No, I'm not sure it's a bigger thing as it used to be, but that is obviously going to potentially keep prices on the back foot for a little while. Not that our markets take that much attention from it. So yeah, really, Philip, depending on what you're looking at, how you're trading it, let us know your view as well. As I say, 77, 76 and a half, up to $80, and go with a break either side as long as it holds. It's pretty much a similar picture in Brent. I haven't got as many lines on it. So what are we looking at here? 81s, 84 and a half. That's your ballpark for that one. But as I said, Philip, let us know what you're thinking. You're long, you're short, you're looking to get long, short, you're neutral. What are your thoughts on that one? Really, a lot of assets, a lot of markets, they're all just waiting around at the moment. Gold still holding above this 24 level, but it doesn't look like it wants to go up to the highs. So again, if you're trading this one, you take your clues from what happens. Either we break back below 24 or we take out the 24.50 highs. And then if you're not in a trade, that's what you want to be looking for to get in something. Either look for a breakdown or a break up. You don't really need to have bias, long or short. You can just do what the price action does and go with it. And if you're a gold bull, you can still short it if it breaks through 2400 if you so wish, and keep a tight stop. And you can always pick it up on the dip lower down to feed your bias for longs, as long as it holds the support where you want it to hold support. Or else you go long on a break 24.50, keep a stop pretty tight somewhere 40s, 35, something like that. And if it keeps on motoring, then you can sit in it and ride it for all it's worth. But doesn't matter what your bias is, the price is going to do one thing or another, and there's no reason not to trade that, whatever your bias is for that one. Similar for Aussie dollar. As I say, a lot of pairs at the moment, all sort of holding their levels. We've had another little move down towards the break point. So this one, again, it needs to take out those highs, 67, 10, 15. If it doesn't take out those highs, it's going to increase the chances that we move back below this break point. And if we do, there's probably quite a few stops sitting under there, and it would probably be a quick trip down to the low 66s if that does break. But while it holds, it keeps these highs in play. So yet again, you can go with whatever side moves first, irrespective of your bias for that one. So Euro Sterling, I've been picking it up in small bits and pieces. As I said earlier this week, if I traded, every time I've traded it off of 85, I've missed 5 opportunities to trade it off of 85 20s. So I started at 20 this morning, ended at 15, got a bid in at 10, 5 pips down. So I've split the trade this time, hopefully to cover a bit of distance. But that data, we were trading around 40s, and as I said yesterday, I was worried if we would have been trading down here 20s going into that number, we probably would have blasted through this, and then we'd have to see what it was doing after that. But on balance, I'm still happy to trade off this level. I'm not yet thinking about flipping the long to a short on my stops, because it's going to have to take something else to get the pound well bid up, but it doesn't mean it can't grind through here. But again, there's going to be some big stops sitting through this zone here. So if it does break, it's probably going to be quite volatile. It's probably going to have some legs, and it'll probably turn the picture a bit more bearish for this one. But for the moment, it's holding. I'll probably you're probably sitting here for the next 6 weeks at 85.15, 85.30k, and before it decides to wake up and go somewhere.
Yeah, but again, for as long as it doesn't break, it's a logic statement. But for as long as it doesn't break, it's still a very big level. And I think the good thing, if you want to trade it purely on a technical basis and you take away everything that's happening in the market, you have one of the cleanest potential trades that there are. This level has been holding so many times that it's really a very, very big level. So if a break there is, it should be a clean one as well. I wouldn't go with if we trade 80, 84, 88 and saying that okay, this is it. We're going to dump, but it should be a clean break if it ever breaks. But until it breaks, it holds. So I mean, this is potentially technically a very nice trade. Your risk is known because of those levels, and also if break we get, we should be trading it now. It's euro sterling. It's the main trading partners still. Well, apart from US and stuff, but they are very close trading partners. So it may be a slow one if we ever go. But I would say if we get a break, the first reaction of the market will probably, because I can imagine there's a lot of stops sitting under there, a lot of entries sitting under there, and just by the sheer volume, it could drop 60, 70, 80 pips. If ever I would trade it, I would on a first leg lower, I would straight away take a fair bid off if I'm short, because it is still euro sterling and it is still one that can hang in a range for, as we've seen right now, it can hang in a range for months.
Yeah, and this one sort of breaks my rule about knocking on the door so many times. Just the nature of the pair, it's very slow, so it can knock on that door a lot. As Kay says, it's been a very clear level. Been trading it a long time. You know, I'm still in a bit of a position from last July. That's how long it's been tradable. But levels don't last forever. So if it does break, it's going to be it should be a pretty big move. But until then, as I say, I'm happy to stay long. And if it goes my way, then maybe in 6 weeks we'll get up to 85.30, maybe 85.50, and we can take it from there.
Yeah.
But it's come through ECBs, it's come through CPIs, BOEs, PMIs, it's come through everything over the last year or so, and it's still holding. So that tells you the strength of a level. But you also have to plan in case it breaks. You can't just shut your eyes and trade it and think it's never going to break. That's not trading at all. Thank you, Philip. You're saying you've been looking for longs but waiting for a clear break from that region. Yeah, that's exactly that. Wait for the break or try and pinch it off the bottom end of the range with a tight one. So good luck with that. Right, Mr. K. Time's ticking, so I'm going to give it over to you, sir. Clickety-click.
Okay. Going from what happened overnight on the Kiwi, it's picking up a little bit again. But we saw I should go on a tighter one. I could go on a tighter one, but I just want to keep it here on a bit of the wider one. You see this whole congestion area that we have been here. We had spike above, spike below, spike above, spike below, but every time we come into this zone here, anywhere between 60 or so, 60, 70 and 61.5 is being hesitant. And again today, after the RBNZ, we've gone up to the 61.5, and again we failed. Okay, so to me, bid on dips. Yeah, that should be the case, because the RBNZ is holding the rates higher. They are not happy about the situation, not happy about the inflation coming off. So I'd say first level here, 60.85, where we started the whole move from, is one to watch on the downside. But I would especially keep a close eye on what's happening with this broken channel here. And that would come in over time around 60.5. So, and 60.5 is also a bit of a retracement level of what we have seen. So I'd say this whole zone here between 60.5, 60.85 in the more medium term is going to be telling us whether the Kiwi can hold or not. Because we, at the moment, as I was saying, we're seeing the dollar doing slightly better. So we are hanging a bit in between here right now. But if the dollar would start to be offered and this thing breaks again above 61.5, then I think we could actually go for a bit of a walk here higher up in the 62s. Okay, I know that our friend Gregor is positioned that way as well, for a bit higher Kiwi, and I must say this still looks relatively constructive, but we have to break this 61 40 50 zone, right? We have to break it decisively, and then we can push higher. One interesting one as well has been this euro Kiwi, right? Since we've broken under 178, 40, 50, 40, 60, hasn't really looked back. We ahead of the RBNZ. We went for a little bit of a correction, and I have this little zone here, anywhere from 177.70 up to 178. The figure is a bit of a resistance already. We had this little spike higher in preparation before the RBNZ, but now we are well back below. Um, I'm I went a little short in this one after the RBNZ, and I'm waiting to see if we could somewhere retrace up to that level and then give it a go again. And then to me, it looks pretty clear that if ever it would fly back through, call it 178, 45, 60, then it's no use to be short anymore. But for as long as that zone there caps, we may not even get there anymore. Looking at the euro losing little bit of steam this morning again. But I think we could we may be on our way to these levels here again, somewhere in the low 176s. And why not? If you look at the wider triangle, why not around 175.5? This would be a nice little target zone for people if you believe that the kiwi is going to remain a fruit full of vitamins. The funny thing that happened, on the back of the of what we saw in the sterling early doors is that all the Swiss pairs have been going for a walk higher as well. So the Euro Swiss is now coming into resistance, and actually. Well, people know that I've been on and off long positions, and I'm actually respecting this level. Just because I didn't see too much of a reason for Euro Swiss as such to continue higher. And we are into this little zone here that I highlighted already a couple of days ago. 99.15, I think, is a pretty decent level to respect. Of course, if it goes through, that's our gateway to parity, right? Then we are probably going to trade parity, and why not go back up to this higher trend line here in the 101s. But first things first, and I want to respect. So I just took profit on that one for the time being. I might, if we get a close back above 99.15, I would have missed 10 points, 15 points, perhaps get back into it. But for as long as it caps, I want to respect this level. On sterling Swiss, we are in an attempt to really break this zone that I highlighted for a long while now, and also the longer term trend line coming in, and that's all happening in this 116, 10, 15, stretch it to 20 perhaps level. We are in an attempt to break here, okay, and it's still looking constructive. If we don't see even a setback into this level, it's risk just continuing, and I think if we get closes above here, the next real stop is going to be back to those levels here, somewhere around 119. That's all possible. I managed my books there as well, and I've raised now my stop just to just below this big zone here, because we could do a little bit of a setback and then continue the move higher. All in all, nothing changes on the other side of the pair. The Swiss franc is still relatively offered. There's still nothing that says in the data that it should reverse. There's no nervosity about the S&P either. So after those data this morning on the sterling, confirming that we are going to be stickier for longer on the CPI, this could continue its move higher, but also with caution. If we get a real close above this level, I may actually add again and and see if we can get those extra 2% out of the market. Let's see. What else was I going to show today? Yeah, we have to look at this dollar CAD, right? That's what I was saying. I'm a little somewhat disappointed. We are hanging right above this little level here, but we have not yet broken. Depending whether you put it here or here, we haven't really broken yet. Yeah, I think anywhere 136.80 up to 137.10 should be an area that should go if we get, for instance, bearish comments or dovish comments from McClem. But we really need to start to make some inroads on those levels and starting to break them to really continue. For as long as they don't, I still think it's not yet a done thing. That will depend on the dollar, of course, but we could still get retests of those levels. We actually went there overnight, right? We went back to this 136.25 trendline support and Fibonacci support. So this is the first level to watch. And of course, this is the other one to watch here, 135.90 figure. If ever, despite those data in Canada, if ever this goes below 135.90, I really wouldn't want to be long anymore this pair. But for the time being, I'm not cash long. I've got a couple of options running. I've got a longer term one as well, covering the next Bank of Canada. But that's a bit higher up, just in the expectation that McClem is going to turn dovish. One that is pretty disappointing is EuroCAD, because yesterday I spoke about this on the on Face, and I thought this 148.20 really when it broke, it should go. So I did buy the break, but then looking at how the euro was behaving, I already let it go. I'm going to be neutral on this one, but to be really honest, I was hoping for more and better here. And but it's a bit typical of what's happening in all those Canadian crosses, right? I mean, EuroCAD there's no follow through. Dollar CAD, there's a lack of follow through as well right now. So we perhaps either need to be patient or just, as I'm going to do right now, leave this one alone. 148 the figure, we are trading on it. 147.95, 148 the figure. Could be a bit of a level, but looking at how the euro is trading right now, I'm not going to catch this knife right now. And anything else, guys, that you want me to talk about, or shall we call this a day? Quick one on the euro mix. Held the support zone here. We are hanging just around this level here, 1801. Let's see what the US wants to do with the dollar this afternoon. Perhaps dollar mix creeping back up a little bit, but if we start to break back below levels 17.52, 54, then it's going to go lower. I think after a while. Yesterday we saw a bit of nervosity on the MEX at some stage, but I think it's still business as usual. Very high yielder, and I don't think there is too much reason for the Mexican peso to weaken right now. But tomorrow we'll have dated GDP Q1 data again, and we will have the half monthly CPI. Just the last one, 18 figure 10 dollar rand. We are building the base there, in my opinion. Still hopium on the election front, but keep a close eye on if we ever start to retest and hold this one. I think I may start to get my butcher's gloves out and catch a little bit of a knife here. To be monitored very closely. Back over to you, Ryan.
Thank you very much, mate. Yeah, we'll call that a day for today. A quick look. I don't even know what we've got coming today. Not a lot. Some home sales, NBA, and not a lot else. So, yeah, not a lot on the calendar for us later on. All that said and done, thank you very much, as always, Kay, for your stuff. And you guys and girls are coming to the Flow Show. Hope we're steering you well with our analysis here. Have a great day, everyone, and we'll catch you again tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.
you.